Hi, in this chapter we will discuss options and its history. Part 2. What does long call means? We will discuss what does long put means, and we will discuss what does short calls or puts means. Now, in the first chapter we will discuss what does long call means. In simple word, you can purchase a stock, but not now. It's at a future date. Let's say you believe Apple would increase 30% within the next month. So you buy a call option. That is saying you will buy it at $100. That is today's price. But you will buy it next month on the 1st. So let's say on the 1st it is trading at $110. So basically you bought it at $100 on the 1st and sold it on the same date at $100. So 10% profit on investing in one day. That's what the hedge fund and institutional investors do. However, you don't have an obligation to buy. It's just an understanding that if you want to buy, then you will. However, you also can change your mind. It's not something that it is obligatory on you. It's just your choice. Example, if you're in profit, you can use it. Or you can say thank you. Now in the below chart, it explains its crux. That is, as you can see, the chart moves higher. The profit tab here, it goes up. So does the payoff. And your premium also increases over time. As the price moves up, your premium moves. So on one hand, you have no problem with it, but you are paying a premium. That is a cost associated with your purchase. Although this strategy pays you off, but initially you need to put up a premium that turns out to be a loss for you. As we all cannot see in the future, so we don't know if this premium will be paid off in next month on the 1st or not. As if you will make a profit, then this premium will be adjusted to the profit. Otherwise, this premium can be added to the loss. Let's say the stock next month goes to 90, that is below 100. Then you can refuse to buy, but this premium will be your cost. Now, what does long put means? Let's say you expect a stock price to crash. Example, an oil stock. So what would you do? You simply get a long put. That is, you say you will sell the stock at today's price, let's say $100 on next month 1st. Now if the stock goes to 80, you simply exercise this option and sell it at 100 and simply make $20 profit or 20% profit. On the other hand, you can simply refuse as well to do anything if the stock is at 100 or more. Now, although this is also a good option to trade, but it also has an associated cost, that is a premium. If you look at this chart, as the profit increases, so does the premium. The payoff also goes up. That is, the payoff is profit minus premium is your payoff. But the premium is the cost that you need to bear. However, you don't need to put all the money up front. Let's say it's a $10,000 stock. You don't need to put it up front. You can just put few $100 and that's it. And you are not under any obligation. Best part is you don't need to purchase this stock today. What does short calls or puts means? Now a short call means you're saying you will sell ABC company stock at today's price, that is $100 at the first of next month. Now in this option, you cannot simply back out of the trade, and you need to fulfill your promise. Now who uses this? You might be thinking, this is the worst thing ever. However, the hedge fund and institutional investor can purchase large quantity of stock through this option and doesn't risk buying huge quantities today. Now in short put, you are simply saying you will buy a stock at today's price next month. And this option is backed by your promise. You cannot back out. Now who uses this? The hedge fund or institutional investor, as they can purchase large quantities of stock through this option and doesn't risk buying huge quantities today. Now in the chart, this is where you, an institutional investor and hedge fund, make the most money. That is, first through premium and then through profit. We will discuss it further in the future videos.